I think what you really should be concerned about is the Fed. And I know that everybody is talking about this, so it usually means it's factored in, but I'm not sure. Because the Fed's about to begin on one of its biggest tightening cycles in over a decade. And it's going to be the first time in their history it's going to do this and have a tightening cycle while all the major indices, you look at the Dow, S&P, NASDAQ, Russell 2000, are trading below their 200-day trend lines. That's never happened in the world, right? It's usually the opposite. When shit hits the fan, you're lowering rates. Well, shit's hitting the fan right now. Money's coming out of the system. The Fed didn't even do anything yet. Which is crazy. March is around the corner. Expect that 50 basis point hike. I'd be surprised if it's not more than that. Market will probably go up on that. And some believe we're going to see 4 rate hikes. Others are calling for 6 or 7 now. And some experts, many that I know, that I've talked to, believe that there's absolutely no way the Fed is going to raise rates 5, 6 times or more while the market is crashing. And to that, I say, the Fed may not have a choice. They might have a choice if inflation doesn't slow down. So for the last year, pounding the table on this, saying money's being directly handed to people. And I'm not, economists are brilliant people, but you're looking at models, and I can tell you, every investment book right now, every investment book that you read right now, just take it and throw it in the garbage. Seriously, because we're in unprecedented times. This shit never happened before. You can't look at past charts or past Fed movements or where the S&P was trading and how it's trading now. Last time this happened, throw it out the window. You threw that out the window when you rejected $10.5 trillion into this market. And that was okay because you chose, lockdowns and people in trouble. And I get it. But that money was not given to banks to shore up the system like it was in 2008. It was handed directly to people and businesses, which is going to filter immediately into the economy. Now, here is why this is crazy and why it's dangerous to be behind the curve, where we had earnings, home prices, net household wealth, used car prices, all assets, basically, outside of gold, of course, all hit record highs this time last year. Not now, this time last year, they hit record highs. But the Fed, instead of saying, okay, things are back to normal, we weathered COVID, we still got some time to go, but let's start raising rates a little, let's start tapering a little. What did they do? They did the opposite. This is a year ago. They continue to buy treasuries and keep rates super low for another 12 months. Well, we saw trillions more being injected into the system, which has led to what? Led to supply chain concerns. It's led to still right now, you try to go to restaurants or bars and you can see these people are still not working. And they're getting paid more to stay home than they were to work, which you can't blame them. I mean, really? If someone paid you right now more money to not work and stay home, would you do it? I mean, can't blame them. But this is what happens when you keep injecting money into the system when you're not supposed to. Now you're behind the curve because inflation is the biggest problem. It's something the Fed can't throw money at to control. It's not like something went out of business or, the markets are getting crushed like 2008 and you're funding the banks, shoring up the system, bailing out everybody. You got to do the exact opposite. You don't have a choice. So people saying that, oh, there's no way. I can't see the Fed raise that many times. No way. They might not have a choice. I mean, have you seen the latest data? We were told for over 9 months now that inflation was transitory. 12 months. We're on 12 months of the Fed, the smartest people in the room, saying that this is going to be transitory because they look back at the past and said this is what happens normally, dating back to 50 years, 100 years, whatever. But this isn't normal. All this money injected into the system. Now you're backed into a corner. But look at the latest data. Again, transitory. It's supposed to be transitory, and they took away that in November. That's fine. And that's when we saw the markets really go crazy and come down and be extremely volatile since then, even to today. But now, even now, look at the latest data. Look at the CPI, retail sales, PPI, which is a producer price index. Look at home prices, which came out today showing an 18% year-over-year increase. 18%. If you own a house, good for you. If you don't, you're being left out. Now you're paying rents that are just going up through the roof, record highs. But when you look at the data, inflation is still not slowing. We're waiting for it, but it's still not slowing. I hope it does slow. That's going to slow the pace of the tightening, and maybe that happens. But we're waiting for it to slow, but it's not. I don't see it slowing at least over the next quarter. If you think I'm crazy, try booking a flight right now to anywhere over the next month or two. Good luck. Wait till you see how much that costs. Wait till you see how much the hotel costs. All the fees are going to charge you on that. I mean, it's insanely expensive to travel, but people are dying to get out because it's just, I'm in Florida. We were lucky. No crazy mask mandates. Our kids were having fun going back to school. Businesses remained open. Everybody was fine. Our statistics turned out to be better than most states, which had masks on every single second of the day and, had forced you to get the vaccine to live your normal life, which is, going indoors to your favorite restaurant in some cities. Nope, you have to get a vaccine no matter what. Even if you're 25 years old and great shape, no underlying conditions, nope. Take away your freedom. Can't do certain things in certain cities. You can't go indoors. You couldn't see the Super Bowl. You can't do anything unless you show your vaccine card. Not too sure if you had to show the vaccine card in LA, though, for the Super Bowl. But I do know that I wear masks, which is insane. For the Super Bowl, paying $8,000 to wear masks. Anyway, when you're looking at inflation here, guys, we need it to slow. And it's probably not going to slow for the next few months. But once it does, that's going to be a boost to the market. With that said, what are we seeing right now? A lot of highly leveraged names getting destroyed. DraftKings, meme stocks, EV names, Virgin Galactic. I love Chamath. He's so smart. Gets into that stock. Space travel is going to be the biggest thing when the stock's at 10, 12, 14, 16, promoting the shit out of that stock, going all the way, whatever it went to, 30, 40, whatever it went to. Then he cashed out along with Virgin Galactic, right? The CEO cashed out. Good for him. Hundreds of millions of dollars. And now he decided to leave the board when the stock was like, 9, 8. I thought you loved it. Didn't you love it like 2 years ago at like 13 to 15? You told everybody to buy it and you got out a higher price. And now you're out of that company. He's like, I'm searching for other ideas. Good for you. You made your money. Who lost money? You guys lost money, right? Nobody pays attention to that. Nobody cares. As long as the retail investors buying what they're selling, they'll sell it to you. And like I say, they'll take every single penny. If you're laying there on the street with a sock on, they'll take the sock off of you and leave. That's Wall Street. It's a perfect example. But those are names that are getting crushed, the SPAC names. That's just, you can see you staying away from those names. There's still, Virgin Galactic's $3 million in sales and still trading at a $2 billion valuation. It was like 12, 13 billion. $2 billion valuation, $3 million in sales. It's pretty crazy. But there are a lot of small caps, even large cap names. Insanely cheap valuations right now. They have strong balance sheets. They're buying back stock, raising dividends. Expect to see strong earnings growth at least over the next 12 to 18 months. And earnings are expected to be strong over the next couple quarters. So I'm seeing lots of exciting ideas, even though it's a tough market. With that said, with so much money coming out of the market, and leverage is at its lowest level since June 2020. Remember that date. I'm going to come back to that. But we could see a little more downside in a lot of these high-quality names that you think are buys in the weeks and months ahead. They could get a little cheaper. So if you're looking at one of your favorite names, you're going to see a lot of these names make their way into our portfolios. For Curzio Research Advisory, Curzio Venture Opportunities, go in these positions small. Take a half position, take a third position, build it over time. Use that volatility in your favor. Because if you're looking 12, 18 months from now, you have a good shot. These things are going to be a lot higher. Why? Because when leverage comes out of the market, which we're seeing right now, right? So leverage coming out of the market and you're seeing short positions, more people shorting the market than ever, it's usually a bullish sign or contrarian indicator. Because the lowest leverage since June 2020, right? That's on record right now. We're seeing the lowest leverage since June 2020. Now, think about that date for a minute. What happened? COVID just crashed in March. Then yet April, May started coming back. In June, they were shorting like crazy, and it was almost the greatest buying opportunity in the past decade since the credit crisis. If you bought anything, you bought almost any name in June, outside of some of the SPACs, because a lot of them are trading below that $10 break point, but almost any stock you bought since June, you're up a ton on, even now, even after the sell-off. It's interesting, right? So now we're seeing the lowest leverage since that point, meaning that you're looking at hedge funds and the big money positioned on one side, which is a contrarian indicator. And if they're super, super bullish, what are they going to do? Well, they're going to sell. They're going to eventually sell, and that can result in a lot of money coming out of the market. Now you're seeing them taking bigger short positions, leverage coming out of the market. Now they're on one side. So you just need a little bit of a positive catalyst, resolve to Russia and Ukraine, the Fed not raising rates as aggressive, inflation slowing, and you're going to see this market really take off. And not all names are going to take off, but the names with strong balance sheets. I mean, you're looking at buybacks. We're going to see probably record buybacks right now. We're seeing companies raise their dividend. We're seeing companies beat and raise this earnings season and watch their stock fall 5-10% and are still trading 20-25% off their highs. These are the stocks you want to pay attention to. It's not. I know your portfolios are down. Most are down. The last 3-4 months have been crazy, but put it in perspective. Because while they're down, the 3 years before this, we saw the S&P 500 go up 30%, 20%, and 27%. Around those numbers. Annually, which is insane for a market that usually goes up 8% every year. Just like home prices up 8%, usually home prices go up 1-2% annually on average. If you're dating back all the way, past 50 years. So when you're going up 18%, could they go up 18% this year? Absolutely. But usually you're going to see that revert back to the mean, which we're seeing even in stocks. So people are like, I'm getting crushed and getting killed. And maybe you got more aggressive this year or late last year as everything was going up and, everybody's talking about how much money they're making. You should have did pretty well the 3 years before, but put in perspective because there's a lot of stocks, semiconductors, energy, the reopen trade. I mean, these stocks are still trading at levels that are 30-40% off their 2019 pre-COVID highs, yet their earnings are going to be higher than they were back then. Think about that. And demand, they have pricing power, and everything's opening up now. Even international markets are opening up. I covered that with Daniel last week. There's a lot of pockets that make sense. I do see positives. Our portfolios are positioned well. But again, buy those companies that have strong balance sheets, expect to grow earnings much faster than the overall market, because that list used to be small since a lot of those names with those qualities are super expensive. But that list is a lot bigger now. A lot of these names are down 25% plus over the past 2-3 months, even though they reported great earnings. They're about to buy back a shitload of their stock because they have great, great balance sheets. They're in the right growth areas. And if you're looking at EVs, if you're looking at whatever you look at certain markets that are growing tremendously within technology. And the chip makers are going to benefit a ton. I don't know if I'd go with NVIDIA, the best of breed, but super, super, super expensive. But Skyworks might be a name to take a look at that pull back. Some of these names have pulled back, and they're in the right growth markets. They have strong earnings. They're about to buy back their stock. And we're looking at the macro, right? 1,000-foot view. Most hedge funds and big money are on the side of, hey, things are going to get a lot worse. And usually that's the time when it's the right time to buy stocks and things get better.